Franking credits are more than a tax detail. They are a powerful driver of wealth in Australia. Historically, they've added an average of 2% to total ASX 200 returns, a huge, often overlooked performance boost. For some, like retirees, this system can mean thousands of dollars in direct cash payments from the tax office. For others, it's a potent tool to legally reduce their personal tax bill on investment income. We will dissect how this works, detail the rules for investors and finance officers, and reveal the system's wider economic impact. At its heart, the imputation system was designed for one reason: to stop double taxation. Company profits are taxed once. It's not a free gift. A franking credit is a receipt for tax the company has already paid on your behalf, a form of prepaid tax. Included in 1987, the system changed in 2000 when the Howard government made excess credits refundable in cash. So how does this affect our two main groups? For finance officers, it demands accurate accounting. For investors, it's about after-tax returns. Finance officers must track these credits in a franking account, applying the correct company tax rate, 30% or 25%, to set the credit's value. For investors, the number one rule is to gross up the dividend. You must declare the total of cash dividend and the franking credit as income. Why is this required? The tax system needs to see the full pre-tax profit assigned to you. You declare the grossed up amount and the franking credit subtracted from tax payable. Imagine a $70 franked dividend. The franking credit is $30. You declare $100 income. If your marginal tax rate is 45%, you owe $45 tax less the franking credit for net $15 payable. To prevent manipulation, the ATO has the 45-day rule. This confirms you are a genuine investor, not just buying for the dividend and credit. You must hold the shares at risk for at least 45 days around the ex-dividend date. Shareholders with under $5,000 franking credits are exempt. With the core mechanics understood, who are the biggest winners and losers in this system? The benefits for Australian residents are clear, but what does this system mean for a company's ability to attract foreign capital? Case study 1, the retiree. With a low tax rate, every franked dividend can result in a cash refund, boosting retirement income. Case study 2, the high-income earner. They use the 30% credit to offset their 45% rate, effectively paying only 15% tax on dividends. Case study 3, the pension phase, SMSF. At a 0% tax rate, they get the entire 30% franking credit back as a cash refund, a powerful outcome. Even in accumulation phase, an SMSF gets half the franking credit back in cash, heavily reducing tax on its Australian share portfolio. As you can see, for almost every type of Australian investor, franking credits provide a direct financial advantage. But the picture gets more complex. Remember our question about foreign investors? Here's the catch. They generally cannot claim franking credits, leading to a form of double taxation. However, there is a partial benefit. Fully franked dividends paid to most non-residents are exempt from Australian dividend withholding tax. This clear advantage for locals creates a powerful home bias, an incentive to prefer domestic, fully franked shares over global stocks. This leads to a policy debate. Does the system push companies to pay out profits as dividends instead of reinvesting them for growth? With all these effects, investor bias, payout pressure, tax benefits, how does it all combine to affect a company's actual value? Recall how the system drives high investor returns and encourages high dividend payouts? This is by design. Companies know investors want them. This creates a direct link to valuation. Franking credits become a tangible economic asset, potentially boosting a company's share price. Let's make one more surprising connection. Remember the gross-up rule? Lenders see this higher income when assessing your borrowing capacity. For finance officers, this means the timing of dividend distributions becomes a strategic tool to maximize the outcome for their shareholder base. Franking credits are not a simple tax refund. They are a fundamental pillar of Australian finance, influencing returns, valuation, and economic behavior. For investors, understanding the rules, from grossing up to the 45-day hold, is the difference between a good return and a great tax-optimized one. For finance officers, precise calculation and clear communication about franking are non-negotiable for compliance and shareholder value. Mastering this system requires diligence. Use a reliable franking credit calculator and seek expert guidance to optimize your financial outcomes.